Hey everyone, we need to talk about what just happened in gold, because it's one of those moves that looks bullish on the surface, but the why behind it is what should really get your attention. Gold is sitting around $4,966 an ounce right now, and in the last 24 hours, it's up just under 4%. That's not a normal sleepy drift higher, that's a real move. And while everybody argues about whether this is risk on or risk off, here's the part that matters. China's central bank reportedly kept buying gold again, extending what's being described as a long buying streak, even as this market has been whipping around like a meme stock. So the question isn't, is gold strong? The question is, why would a major central bank keep adding to gold into this kind of volatility? Because if you understand that, you understand what the next phase could look like and what it could do to your savings, your portfolio, and the price levels we're going to be talking about next week. Now, what you're seeing isn't the mainstream explanation. Most commentary is going to sound like this. Gold went up because investors got nervous. Or gold went up because the dollar did this. Or gold went up because yields did that. But the real story is more structural. Three critical events just collided. First, the plumbing of the futures market is under stress. When you hear that CME is raising margin requirements on gold and silver futures, that's not some boring technical footnote. That's the exchange essentially saying, this market is moving so violently that we're changing the rules of how much cash you need to post just to keep your position open. And here's what that means in plain English. If you're levered, and a lot of traders are, a margin hike can force you to sell even if your long-term thesis is right. It's not about being wrong. It's about not having enough cash at the exact wrong moment. That creates liquidation, forced selling, sudden air pockets. And then what happens after forced selling? You get these snapback rallies that feel like a miracle until the next forced wave hits. So even if you're bullish gold, you need to respect the mechanism. This is a market where structure can move price as much as fundamentals do, at least in the short run. Second, the silver side of the complex is acting like a stress amplifier. Silver is around $77 and change, up almost 10% over the last day. But the important part isn't just that it's up, it's that it's been behaving like a market that's trying to find a floor and can't decide where reality is. And when silver gets that kind of wild, it doesn't stay contained. Why? Because silver is smaller, thinner, and more prone to violent positioning shifts. That makes it a kind of volatility engine for the entire precious metals trade. When silver starts whipping, it can pull gold with it through cross positions, hedges, and risk limits. Funds don't always treat these as separate worlds. They manage them as a complex. So a silver shock can create gold aftershocks, even if gold's long-term story is different. Third, while traders are getting forced around by volatility, central banks are behaving like they're playing a different game. This is the part that should make you sit up. Because when a central bank buys gold, it's not doing it for a quick flip. Central banks aren't buying gold because they think they can sell it next Tuesday for a profit. They buy gold because it's one of the few reserve assets that doesn't depend on someone else's promise to pay. So when you hear that China's central bank is still buying, extending its buying streak, you have to read that as a signal, not a price signal, a regime signal. It's them saying, no matter what the market does this week, the direction of our reserve strategy is still the same. And when those three things collide, margin pressure, volatility contagion from silver, and central bank accumulation, you get a market that can do two things that confuse retail investors the most. It can rally hard while still being unstable, and it can crash hard even when the long-term thesis is intact. That's exactly how people get shaken out. Now, here's what Wall Street analysts aren't discussing enough. This kind of environment changes how you should interpret price action. A lot of people see gold up nearly 4% and they go, okay, we're back. The dip was the opportunity. Maybe. But in a volatility regime, the most dangerous words in finance are, we're back to normal. Because normal markets don't require constant margin hikes. Normal markets don't have silver funds halting and resuming, and silver moving like it's got a turbocharger strapped to it. Normal markets don't make gold behave like a safe haven one day, and a high beta risk asset the next. So I want to give you the clean framework I'm using right now. No charts, no fancy indicators, just logic you can hold in your head. The first layer is the institutional layer. Who is forced and who is not forced? The forced players are the ones using leverage, or the ones who are under risk limits, or the ones who have to meet redemptions, or the ones whose broker just called and said, add cash or cut the position. Those players don't control their timing. They sell when the structure tells them to sell. The non-forced players are the ones who can buy without caring about next week's volatility. Think central banks, think long-duration allocators, think entities that don't mark to market the same way a hedge fund does. And when you see central bank demand continuing into volatility, you're watching non-forced demand absorbing forced supply, or at least attempting to. That's important, because when forced supply meets non-forced demand, you don't get a smooth trend. You get violent swings that ultimately resolve into a new level. Not immediately, not cleanly, but that's the process. The second layer is the narrative layer. What story is the market trying to price? In the public conversation, gold is still treated like it only moves on fear, inflation, and the Fed. But central bank gold buying isn't just fear. It's diversification away from counterparty risk. It's a hedge against sanctions risk. It's a hedge against reserve weaponization. It's, in many ways, a quiet vote on the long-term credibility of paper reserves. You don't have to turn this into some conspiracy. You just have to accept that the incentives are changing. And when incentives change, flows change. And when flows change, price eventually follows. The third layer is the what happens next layer, the part that matters for you. Because even if you don't trade gold, this affects you. Let's make this personal. If you've got $100,000 sitting across a basic mix, some stocks, some bonds, maybe a little cash, weeks like this are where people get surprised. Gold moves like this are telling you something about the environment, not just about gold. They're telling you that volatility is back in the system. And when volatility is back in the system, the range of outcomes widens. That means your portfolio outcomes widen. It's not just up a little or down a little. It becomes up a lot or down a lot quickly. Now, I'm not saying gold is the answer to everything. I'm saying gold is a signal, and this signal is flashing while central banks keep pressing the buy button. So let me give you two very real scenarios that can happen from here, and you'll recognize them because they happen in cycles. Scenario 1, the air pocket then launch path. This is where margin pressure and volatility create one more ugly flush. People panic. Headlines scream. Everyone says the trade is dead. And then, because the structural bid is still there, including central bank buying, gold stabilizes and grinds higher, and you look back and realize the flush was a transfer from weak hands to strong hands. Scenario 2, the violent range path. This is where gold doesn't trend cleanly at all for a while. It swings hundreds of dollars, maybe more, back and forth. It burns out both bulls and bears. It punishes anyone who needs a straight line. And then after enough people give up, it resolves. The reason I'm bringing this up is because either scenario can happen, while the long-term direction remains bullish. This is why so many people miss the move. They're right on direction, wrong on survival. Now let's talk history, because we've seen versions of this playbook before. I've tracked this pattern through multiple cycles, and one of the clearest modern parallels is 2020. In early 2020, the world got hit with a shock. Not just a health shock, a liquidity shock. And what happened? In the first phase, you saw sell what you can, not sell what you want. That's forced selling. Even assets that people considered safe got hit because funds needed cash, and they sold winners, they sold hedges, they sold anything liquid enough to raise money fast. Then the second phase arrived, policy response. Liquidity came in, rates collapsed, and suddenly the narrative flipped from sell everything to what survives a debasement cycle, and gold responded. But here's the part most people forget. It wasn't a straight line. There were gut punch drops that made people question everything. And then, when the dust settled, gold was dramatically higher than where it started. That's the psychological sequence. First, volatility breaks confidence. Then structure forces positioning changes. Then long-duration buyers accumulate. Then price re-rates. Now, am I saying we're repeating 2020 exactly? No. But the psychology and mechanics rhyme. And today's twist, the one that makes this cycle feel different, is the visible, persistent central bank bid in the background, while market structure is visibly straining. In 2020, people talked about gold demand like it was mostly investors. Now you're watching official institutions treat gold like a strategic reserve component in an uncertain world. That doesn't guarantee up only. But it does change the who blinks first dynamic. And if you want one simple takeaway to hold on to, it's this. Traders care about the next week. Central banks care about the next decade. When those two worlds collide, the short term can look insane, but the long-term signal can become clearer, not weaker. So here's what this means for you practically. If you're a long-term holder of anything, stocks, bonds, real estate, a business, this is not the moment to be complacent about risk. This is the moment to be honest about what you actually own. Do you own assets that depend on stable financing conditions? Do you own assets that assume low volatility? Do you own assets that perform well only if the world stays calm? Because when gold is at 49.66 with a near 4% daily move, and silver is ripping almost 10%, and exchanges are hiking margins, the system is telling you calm is not the baseline right now. It's telling you the baseline is turbulence. And turbulence changes everything. Borrowing costs, risk appetite, correlations. the way diversification works, all of it. Now let me be equally clear. Nobody knows the next tick. We might see gold go higher from here. We might see it drop hard first. We might see it chop and whipsaw and make everyone miserable. But the window that matters isn't, can you predict tomorrow? The window that matters is, can you recognize a regime shift while it's happening? Because when central banks keep buying into volatility, they're not trading, they're repositioning. And if that's what's happening, the real story isn't today's candle. The real story is the direction of the reserve world. Look, the question isn't whether volatility continues. The math is clear. When leverage meets margin hikes, you get forced behavior. When forced behavior meets thin liquidity, you get violent swings. And when long-duration buyers keep showing up in the background, you get a tug-of-war that eventually resolves. The real question is, are you positioned for what comes next? In every previous cycle where volatility returned and confidence in paper promises got tested, tangible assets tended to preserve purchasing power better than narratives did. Right now, gold sits around 4,966, and we're in an environment where the next week can determine whether this move becomes the start of a new leg, or just another brutal whipsaw inside a bigger range. I share real-time updates and deeper analysis on social media. For those wanting exclusive research, members-only analysis, or early warnings, there's a premium level. This is educational content, not financial advice. Do your own research. Consult licensed financial advisors before making investment decisions. These are market observations and analytical frameworks, not buy or sell recommendations. But the fundamentals and the flow behavior tell a story. And that story is getting louder. All right, before you go, 3 quick things. 1, drop a comment below. Tell me where you're watching from, and give me your prediction. Where do you think gold is headed by the end of the month? 2, if you're not subscribed, hit that button now. I'm putting out unfiltered analysis consistently. And listen, I'm fighting copycat channels stealing this content. If this video provided value, comment data over hype, so the algorithm knows you're here for the original. 3, next video drops tomorrow, and I'm covering the one indicator that tends to show up right before volatility turns into a full-blown trend, and it's flashing again. You won't want to miss it. See you there.